Everybody, thanks for tuning in to today's video. My name is David, and we're going to be talking about the top retirement tips for anyone who is, say, ages 55 to 64, 65, basically 5 or 10 years out from retirement. All right, so let's get into these 7 top tips. If you're new to this channel, go ahead and like and follow my channel so that you can get updates as to when I release new videos. We do videos, live stream videos every Wednesday at 7 o'clock right across LinkedIn, Facebook, and YouTube, and then 1 or 2 new videos per week in addition to the live stream. So let's get into the first one. Number 1, get a retirement plan. So this is actually something I talk about in every single video. I think it's really important that everybody has a financial plan, because financial plan is seeing the outcome of your planning decisions before you commit to them. A financial plan is usually 18, 20 pages, could be even longer depending on your situation, if you're a business owner or whether you're an individual. And so it's really important to do this. But one of the things I'm going to lead you through here is just a couple of slides on some of the higher points that most people come to want to plan. And one of the biggest questions that people have is, do I have enough money to retire? It's actually the number one financial worry that most people have out there. Do I have enough money to retire? Or how long will my money last? Or will I outlive my money? There's variations on the same kind of question, but let's have a look at this one slide. This is called a cash flow. This is one of the slides or one of the pages in a financial plan. That gray line that's running left to right horizontally across the page at the top of each of those bar graphs is the lifestyle expense. So that's you saying how much you plan to or expect to spend in retirement. So this person is saying, I think I'm going to start off at age 65 somewhere around $80,000 worth of expenses, so I need enough income to last me that year and every year all the way up to age 90. You see at the far right hand side of the page. So what this is showing is that the gray area is government benefits, so CPP, old age security, and then the blue areas are really their retirement, so RRSPs or tax-free savings accounts, that kind of thing. The red is a deficiency. That means someone doesn't have enough money to fully fund their lifestyle expense in that year. So if you look at year 74, that's where they start to run out of money and they can't fully fund that $80,000. It's now $100,000 at that mark. And you'll see that in age 75, certainly 76, they have 0 of their own cash left. So no RSPs, no tax-free savings account, no non-registered account. They're living off of government pension plans, so CPP, old age security, and likely probably GIS, guaranteed income supplement. So this is what this person comes to me with, and they say, this is my current situation. Then what we do is we put a financial plan together so that it looks like this, where they actually have enough money to fund their lifestyle. They don't run out of money. They don't have clawbacks on their government benefits. And you'll see also from age 72 all the way up to age 90, they actually have more money than they're going to need in retirement. So it gets to talking more about, charitable giving, what you want to leave behind to your grandchildren and children. So it's a completely different conversation. So that is what a financial plan can do for you. And that's the number one thing. That's the first place you ought to start. Everyone gets a financial dashboard of my clients so you can get a sense of what this is. And I'm just going to run through this really quickly. The financial dashboard really summarizes an 18 or 30 page document so that it's easy for you to see on one page instead of going through your entire financial plan. So I'll run through this really quick because I want to get through all 7 of these in under 10 or 15 minutes. Okay, so we'll be talking about, by the way, these areas on this dashboard are the areas that you have decided you want to track. These are your goals. These are my goals, my personal agenda here for you. This is your goal, and you're saying, I want you to track these so we can really measure the effectiveness and how close we are getting to our goal. So the first one is your net worth. You want to make sure your net worth is going up because that's how you actually get credit and having a good credit score. What is your rate of return? So many people focus on rate of return. That's not what retires you. What retires is your income at retirement. I'll show that with you in a second. How much money have I made for you since we started working together? What does your total assets look like? Are you more house rich or are you more investment rich? So what this is really saying to you is that if you don't have enough assets to retire and you're sitting on this big wedge here, which happens to be in this example, their home, 77% of their total net worth is in their home, then this person might be having to sell their home at retirement in order to actually have a retirement. Then how much debt you have to pay off. This is the next one. This is the biggie. You've got to pay attention to this. If your advisor is not talking to you about what is your projected income at retirement, then doing a real disservice. You really want to know this number. Being able to brag about your rate of return, it's nice, but it's not important. What's really important is this bottom left-hand corner. How much income does your assets produce for you, or expected to produce for you at your retirement date? So this is the date, according to your plan, when you plan to stop working and retire. And this is really where the rubber hits the road. You want to make sure that you're on track to having enough income to retire. And it's kind of also tied into how much money you have invested. So this is a biggie on the financial dashboard. And then the next one, of course, is, how close are you to retiring? I always like to put this visually for clients because I think it's important that they see, visually, are we close? Are we getting there? And it's kind of encouraging for them to see that number, that percent to retirement getting bigger and bigger. Okay, let's move on to number 2. What is your expected CPP and old age security benefits? This is actually key to understanding your retirement income. One of the first things you can do is you can just head on over to my CRA account online. You can get this easily by just logging in, or you can call CRA in about 10 or 15 minutes. They'll tell you what your expected CPP benefit will be, what your old age security will be if you continue to fund it to the maximum between today's date and when you plan to retire, like age 65, for instance. So it's easy to find that number because your actual retirement income, if you get an average, the average payment is about $19,000. So you think about if your goal is you needed $60,000, well, that's a third of your income. So this is really important for you to think about. Now, if you only need $60,000 and you know that you're going to have an average CPP payment between you and your spouse, then now you've got $40,000 worth of that $60,000. So you have to make up that little bit that's left over, and so that's really important. These things will really help you. This one thing you're going to do is really going to help you to start to solidify that, will I have enough money to retire? Get this number straight. Now you can also go onto CRA's website, have a look here. This is an actual planning tool. I've used it. Check out this video up here. You'll see that I actually did a run through on this, a live video on this, so people could see me going through the actual website. And it's actually very good from a CRA point of view. I was quite surprised. Number 3. What is your retirement income projection? Back to that financial plan in that left-hand corner. This is what I was saying is the most important thing for you to know about. It's not enough just to say, I've got 19% rate of return, or I've got 10%. Whatever that rate of return is, you really want to know what is your retirement income and what is your retirement lifestyle expense. So how much you're going to spend every month and how much money can you get out of your portfolio. And your portfolio might be not just assets like RRSPs, TFSAs, and non-registered account. Maybe you've got rental property, right? Maybe you've got an Airbnb somewhere. Maybe you've got a business that you're going to turn over to maybe your adult children, and then you'll get some money each month out of that business while they're running it as well. So this, if you're a business owner, all of that is going to be contained into this document as well. So it's not one thing. The other thing would be, do you have a pension plan? Some people actually have a defined benefit plan. If you're thinking about teachers and public service workers, government employees, they all have pension plans. So one of the things might be, will you plan to commute your pension, for instance? This is a massive decision for someone to make this decision, because all your life you've been working, saving your money, contributing to your pension plan, having a decent income, and then all of a sudden you've got $1 million+ to use in retirement because you're commuting your pension, and it's probably the first or second biggest financial decision you've made. Your house might have been the one big one, and then commuting your pension or not is your second biggest financial decision. So these are all important things you want to get done right away. Number 4, fund your RSP to the max. This is so key. If you are using RSPs, and I want to make this asterisk in my delivery here, and that is you might not be using RSPs. You might have different investment vehicles, but if your RSP is your retirement account that you're using, fund it to the max. You have to talk with an advisor about how can you catch up all your unused contribution room and get that thing totally funded. And one of the places you want to look to is if you're working for an employer that has a government or a group retirement plan and they have a matching program, most group plans have a matching program, then start there. Start contributing the maximum you can. You'll see things like 4 or 5% of your base income can go into this plan. So you want to make sure that you're capturing all that free money from your employer first before you give it to an advisor like me, because you get free money from your employer. After that, then go to an advisor and start funding your RSP. It's super important that you get that free money, okay? Number 5, don't forget about your tax-free savings account. This is really important. Have a look at this graphic here. This graphic shows a retirement timeline. And let's say you're planning on retiring at age 62, but weren't thinking about taking your RIF until age 65. Or maybe you were going to say, I'm not going to take my RIF, so converting your RSP to a RIF, until age 71, but I will take my government benefits, CPP and old age security, at 65. So you know you've got some income between you and your spouse. You might have, let's say, $40,000. It's going to start when you're at age 65, but you decide to stop working for whatever reason. Could have been that's it, you're sick of working. Maybe you've lost your job, like in the case of the pandemic where employers just terminated people because they didn't have a job for them, and they may have not had a business anymore. For whatever reason, you've decided at age 62, but from age 62, 63, 64, what's the income that you're going to use to retire on? So that's why I have it in red there. There's 2 years there where you don't have a paycheck coming in. So this is a perfect spot for your tax-free savings accounts for both of you, if you have a spouse, where you can have money sitting in a tax-free savings account ready to go to fill those gaps, so that when you get to age 65 and you start your government benefits, it's those gap years, right? That's a really awesome way to use your tax-free savings account. So don't forget to fund your tax-free savings account as you go along, so you can have enough cash to fill those gaps if that's your situation. Okay, number 6, dial back your risk. Wow, I see this so often. A lot of people forget about their risk tolerance and they continue to invest money the same way they invested when they were 40 years of age. And now you're 5-10 years out and you're still aggressively investing your money. Do you know, when you look at 2008, the market crashing so suddenly, 2022 from January right into the end of March, negative returns in most portfolios, unless you're invested in Canada where the market didn't really decline, didn't really go up that much, but it didn't really decline. And so what people are seeing is that they get caught off guard and they go, wow, I forgot to lower my risk tolerance. Meaning, look at this illustration here. Conservative at the bottom left-hand corner, all the way up to aggressive on the top right-hand corner. So that the aggressive risk tolerance is your most vulnerable position to be in, because it's heavily weighted in equities, stocks. So you see that 85-15 split. The 15% is fixed income, slow, low return, bonds basically, right? So you don't want to be, if all you have to retire on is your current RSP portfolio, and you don't have a group plan coming in that's going to provide an income from you. You've looked at your CPP and you said, gee, I'm not going to have a big CPP payment either. Well, if that's all the money you've got, you don't want to be aggressively invested 5 years before you retire, because you don't have time to pick up any losses. So it's important that you start to dial back the equities in your portfolio so that you're down to maybe somewhere around moderate or even balanced. Balanced would be kind of the highest I'd want to go, but certainly between balanced and moderate. Last one, pay off your mortgage. Now, I say this with a bit of a caveat here. And I say here in this picture, how do you use your home equity? This is really important, because if you are planning to remain in your house during retirement and you have enough money to retire so you don't need the equity in your home, then you might be wanting to use the equity in your home to fund other things. So when I say pay off your mortgage, what that means is I don't want you having to have a mortgage payment while you're retired and you're drawing on your RSPs. If you're not going to be using the home equity to actually fund something else like a rental property or another, maybe you're decided to start a business in retirement. So I don't want you to just simply say, I think you need to pay off your mortgage with everybody. What I'm trying to say is, if all you have is an aspiration to retire and use your RSP and your tax-free savings account in retirement, then pay off your mortgage. But if you have plans that are bigger and much larger than that, then you may not want to be paying off your mortgage. You may want to have a line of credit on your house that you can continue to go and fund those other assets that would produce an income to you in retirement. So that's it. Hope you enjoyed this video. I like to tell everybody we like to take care of your wealth management so you can take care of what's most important to you. I really believe in that. I want to thank you for joining me on this video today. I look forward to seeing you in the other videos. If you have any questions, please put your comments down below. I love your comments. I even love your video suggestions because I love making videos that you want to hear information about. If you have any questions at all, please feel welcome to contact me. I look forward to seeing you in the next video. Thanks very much. Take care.